Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Robert Teeter joins us, Chief Investment Strategist at Silvercrest Asset Management. So, Robert, given the backdrop of a solid, more than solid 2025, stocks, bonds, commodities, how are you kind of framing out 26?
Yeah, well, I think we're starting to see some of the clues for 26 in the fourth quarter here. And by that, we've had continued expansion in the economy, fantastic earnings season, a couple of rate cuts, and yet you've had a fairly choppy but still up market. So we're at new highs here. I would kind of call them tentative new highs. We took a lot of fuel to get here. And there's been a lot of rotation in this market as well, both on a sector basis, a market cap basis. You're starting to see a lot of churn. And so to me, that's a healthy sign for 2026. Might have to dial back expectations a bit. It might not be quite as strong as this year. But you're starting to see more guests arrive at the party, if you will, in terms of the broadening out of the market.
That's certainly good news. Yeah, we want to talk about other stocks involved in the party. But do you think we're going to continue to see mixed messaging? We had strong GDP numbers. They don't seem to really jive with the labor market, which is weakening.
Yeah, absolutely. That is a really interesting disconnect. And I think that also sets the stage a little bit for next year in terms of how we think about the economy versus earnings. And so one of the themes that we've seen has been that companies have been very slow to hire. You've had a relatively soft labor market. That's not great from a consumer standpoint, but so far it seems to be pretty great from an earnings standpoint. And that is a sign that some of these AI benefits are coming into play. You're hearing more and more CEOs talking about keeping headcount flat while revenues are rising. And so that's good for the earnings picture. Again, not so great for the consumer picture, although payrolls are still expanding, albeit slowly, and wages are still expanding, also, albeit slowly. So we're not in a spot where we're fearful of a recession, just mindful that we might have a little bit slower economic growth to work off of.
Robert, you mentioned earnings. We had a really solid earnings year in 2025, second quarter, third quarter, really strong. Is the earnings outlook for 2026, is that enough to support this market?
I think it is. My base case for next year is that we do see very solid earnings growth, so kind of low teens earnings growth, maybe a little bit of multiple compression, though. And part of that's just going to be a factor of some of this rotation. Maybe you get a little bit of pressure release valve out of the mega caps that have been so strong, and I think strong for good reasons. But as you get some of that rotation, multiples might come down a little bit. So we're looking for high single-digit gains from equities next year, powered by double-digit earnings gains.
What are you expecting from commodities next year? And I'm really talking precious metals. How much more of a runway can we possibly have? Silver's up, 170%, I think, year to date?
Crazy.
Yeah, it's hard to stand in front of that momentum train, and I think it may continue, although it should be pretty volatile. We've seen that this year as well, where we keep moving higher and higher in the commodity space, particularly, like, say, precious metals. There's a good trade behind that, I think, which is people are really looking for something outside of equities as a place to store some capital. It's tough to find a spot to do that in bond markets. Yields are pretty solid here, but you don't want to put all your eggs in that basket, just given some of the difficulties on debt and deficit in many of the major developed markets. So commodities have been a pretty good pressure release valve for some of that interest.
We haven't talked too much in the last few days, at least, about the Fed. We're getting that. We got that cut in December. I think the street's kind of looking for one, maybe two cuts in 2026. If that's in fact the case, is that enough for this market, or does it need more, do you think?
I think that's enough given where we are right now. If you see multiples rise any further, that could be problematic. The real challenge for the Fed is that issue between GDP and labor market. Their mandate really is on employment, less so on GDP. And so whether they choose to focus on a softer labor market and respond to that with rate cuts, whether they change the target at all in terms of whether they're concerned that rates are overdue, those are some of the challenges that they'll be facing. But I think so long as the backdrop is rates will be lower in the future, that supports multiples. And that's been our view all throughout the course of this year. It doesn't really matter the pacing of the rate cuts, just knowing that they're coming and knowing the path's lower.
You said it's nice to see investors look outside equities. We were talking about precious metals a moment ago. What about Bitcoin and just crypto in general? Is that a place that people should still be looking at in 2026?
It's a really interesting and challenging spot. It's very much more of a momentum trade. So hit a high earlier in the year and came down in terms of Bitcoin. Hasn't really correlated exactly with gold and other precious metals. And so it's a really challenging spot. On the one hand, it sort of trades like NASDAQ. On the other hand, it sort of trades like gold. And so you just have to be careful of how you're sizing positioning there. One of the things that we've noticed is that people do tend to trade it with momentum. And so with it significantly off highs, it probably doesn't attract much more attention until you clear those highs. We do like outside of U.S. large cap equities, we do think some of the smaller cap space is starting to see a bid as well with that broadening. And we're hopeful that the earnings broaden out there as well.
And that lower interest rates could also help to buttress those smaller stocks.
Absolutely. They're much more interest rate sensitive, much more financing sensitive. And our view has been that this AI trade will spread from the mega caps, from the builders to the people using the technology. And as you start to see some signs of that in small cap, that should help the earnings backdrop.
How about U.S. versus non-U.S. in 2026?
Yeah, we're still favoring U.S., even though we've had a nice bid outside the U.S. It's been encouraging and healthy to see. Same as with small caps, as you see other parts of the market start to do well, that's a healthy signal. But we think longer term and over our 3-year forecast horizon, U.S. has better demographics, better growth, better innovation than most of the other parts of the world. Some pockets in EM could be interesting, but by and large, we think U.S. is the place to be.
Are you worried at all, though, that the consumer may really pull back here? I mean, the consumer is sort of stuck through it all. We throw a bunch of things at ourselves. Right? We've got inflation with lots of geopolitical tensions. Now these cracks in the job market. But if the consumer does pull back in a meaningful way in 2026, I mean, AI or no AI, I don't know how these earnings keep up.
Yeah, it's a great point. I mean, the consumer is a really challenging area to evaluate right now. So most of the spending coming from the top end, you've had the wealth effect there. It's been this positive flywheel of, wealth effect feeds into more spending, feeds into more wealth effect. And that's been in place for quite some time. And the lower end consumer, no doubt, is struggling and will continue to struggle. And it's spread from to other areas as well. You've seen people with college degrees that are younger having a harder time getting a job, unemployment ticking up there. But by and large, in aggregate, the income is there. So we look at a metric where we look at payroll expansion, which is a little over 3%, wage gains a little over 3%, net inflation out of that. And in aggregate, the consumer still has money to spend. It's just in pockets.
Yep, absolutely. All right, Robert, thank you so much. We appreciate it. Robert Teeter, Chief Investment Strategist, Silvercrest Asset Management. Really appreciate you coming into our studio on Christmas Eve. You get an extra star. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
How are retail sales looking these days? Are people out there shopping this holiday season? How's it looking? Nicole Larson, National Manager of Retail Research at Colliers, joins us here to give us an update. So, Nicole, it seems like I'm hearing some pretty good things. The consumers out there spending. The malls seem to be pretty full. People are clicking away on their e-commerce. Give us the latest numbers.
Yeah, so we're really expecting the holiday shopping season this year to be fueled by online shopping. So we're expecting online sales to grow about 6%, and we're expecting in-store sales to grow about 2%. But that doesn't mean that consumers aren't out there at the mall. I mean, I just drove by the nearest outlet mall to me, and it was really packed yesterday, so I can only imagine how today will be. But, also those malls that have some sort of experiential component to it, like American Dream, Mall of America, they saw really high foot traffic, close to 8 to 10% gains for Black Friday. So we're continuing to see consumers willing to spend so long as there is some sort of value or entertainment component to it.
But talk to me, Nicole, about how artificial intelligence is playing a part in holiday shopping. Because I think this is the first holiday shopping season where we're really seeing AI sort of take on a role.
Yeah, so AI actually really fueled a lot of the Black Friday sales that we saw a few weeks ago. And it's really interesting because AI has become this, household staple now. So it's helping us grocery shop. It's helping us, find the best discounts out there. It's making sure that we're price checking. So it's really made us as consumers a lot more, savvy, I would say, when we're shopping. And that's why you're going to see a lot more online sales growth this holiday season as opposed to in store.
Do the retailers have any idea what they're doing with AI? How's that? I can't even imagine. It's so new.
Yeah, I would say, in 2026, the retailers expect AI to be accountable. So they are not going to invest in, these really expensive tech platforms or automation unless they really see a value, because us as consumers, we just move so quickly with all this technology. So by the time the retailers actually implement it in store, we're kind of past it. We've moved on. It might not provide as much value as they thought. So that's going to be really important to retailers heading into New Year, that any sort of AI automation technology that is being put into their stores is definitely going to need to be helpful and provide the best return on investment.
But what about what we are buying? Because I know that consumers have been much more intentional about the things they buy. We're seeing consumers in the mid to low end really pulling back, especially on discretionary spending. So what have we been spending our money on this season?
Yeah, so really interesting. We're actually seeing service spend grow. So whether that's, on wellness, any sort of experiential, going out to theme parks, going to concerts, we're seeing that kind of spend grow as opposed to goods. And, we actually took a survey, and a lot of consumers said that they would actually rather spend on going to an event with a loved one, a family, a friend, instead of buying them a physical item. So we're definitely seeing a shift, and I think we'll see that into the new year.
Is there any have to have kind of gift out there? Is there any tech gadget that people have to have out there?
Oh my gosh. I mean, like I said, tech moves so fast. I just got an Aura ring. I really love it. I think wearables
Aura ring. Oh, nice.
I think wearables
going old school, Nicole.
I know. Yeah, I got it on a really good Black Friday sale. But I'm starting to see wearable earrings that, can track your heart rate and all of these different things. So I think anything that's, aside from an iPhone and Apple Watch, those are sort of like must-haves we already have in our household. But anything that can, help track your wellness, help your well-being, I think you're going to see a lot of consumers be willing to spend on that type of product.
I remember when, I'm really dating myself, I remember when Cabbage Patch Kids were like all the craze. And I just remember my mother just going insane trying to get one for my younger sister. It was dangerous out there in the mall. So I don't know what the equivalent to Cabbage Patch is nowadays, but maybe, I don't know, is it your Aura ring? I don't know.
I was going to say maybe a Labubu. I don't know. Those are hard to find.
We talked about those on this show. Yes.
Yep. All right, Nicole, thank you so much for joining us. Really appreciate it. Nicole Larson, National Manager of Retail Research for Colliers. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We're going to check in with Teeter, Tchir, head of macro strategy for Academy Securities, get his thoughts on 2026. Boy, it's going to be tough to beat 2025, but what is the outlook for stocks, bonds, currencies, commodities, all that kind of good stuff here? We're also going to talk to David Katz, president and CEO of Matrix Asset Advisors, on why value and small caps outperform in the year ahead. Boy, that would be a counter call. We haven't really seen that in a long time. So we got a lot coming up on the markets. Really looking forward to 2026 here as we wind up 2025. Let's kick this hour off. Elise Mateo, any Bloomberg Business Flash?
Yeah, we've got stocks hovering near all-time highs ahead of the Christmas break, but little movement in futures. S&P futures down a fraction. Dow futures down about 28 points. NASDAQ futures are little changed. In the yield space, not much movement there as well. The 2-year, 3.54%, and the yield on the 10-year, 4.16%. Gold, silver, platinum set fresh records. Copper headed for an annual gain of about 40%. We go to the Bloomberg Dollar Spot Index, weakening by about 0.1%. We are keeping an eye on Intel shares this morning. They are down more than 2%. Reuters reporting that NVIDIA stopped testing whether it could make its chips using Intel's 18A production process. That's the reason for that. And we have deal makers working right up to Christmas. Sanofi had agreed to buy Dynavax Technologies for about $2.2 billion. It's a bid to expand its vaccines business, currently anchored by a flu shot franchise. Shares of Dynavax Technologies are up about 39% on that news. And BP set to raise about $6 billion from selling a 65% stake in its Castrol lubricants business to Stonepeak while retaining a minority interest. That is your Bloomberg Business Flash. Alexis and Paul.
All right, thanks so much, Lisa. 8:02 on Wall Street. Want to dig into these markets a little more and what might be in store from looking at it from the lens of a macro strategy. And who better to do that than Peter Tchir? He is head of macro strategy at Academy Securities. Peter, thanks so much for taking time out of your Christmas Eve to be with us. We appreciate it. So from your lens, looking at things on the macro level, inflation, GDP, interest rates, does this market have what it takes to give us returns similar to 2025?
Yeah, I think there's that potential. I think, one, yields are going to be under control. I think we are going to get cuts. The new administration, they're going to push people through the Fed that want to keep rates low. There's all this concern about the long end of the yield curve getting away from itself. I think they will do Operation Twist or anything else necessary to keep, the 10-year under 4.25, 4.50, and they're actually going to try and push it under 4%. So I think the rate backdrop's going to be good. And then I think the main driver is going to really be what we've been calling this production for security, or PROSEC, where you're seeing Besant talk about this more and more, right? The need to make chips, the need to make electricity. More and more things are going to be made domestically. And I think that's going to be a big part of this administration's agenda. They've already started it. I think it's gaining momentum. Not only did this get jump-started kind of by the admin, you're starting to see asset managers really chase some of these possible, companies. You're looking at private equity, searching for companies that have mines that, maybe were useless under prior administrations that could be useful. So I think it's all going to be reasonably good. I do think the AI story might not be the driver, though. I think that might be a little bit overplayed right now.
It's kind of where I wanted to go, Peter. I mean, I guess if we look back here in some of the outperformance in equity markets in 23, 24, and 25, it just seemed increasingly during that period of time, AI was the driving theme here. How do you kind of position that for 26?
So we've kind of been looking at it two ways, and we're talking about the AI debt diet. And you certainly can watch the, credit default swaps of some of these names have widened. You're seeing a little bit of pressure both in the public markets and the private markets. So I think there's going to have to be a little bit more clarity from the hyperscalers and the big data center buildouts on what they're willing to spend, how they're willing to spend it, if there's any conditions under which they might not spend. I think that will slow it down a little bit on the spending side, not dramatically, and it might actually turn out to be slightly healthy for the stocks and very good for the credit. The other thing that I don't think happens is whether we get an AI spending diet, where do companies actually slow down their spending and demand for AI? I think a lot of companies are showing benefits of using AI. At the same time, I think there's a lot that are left kind of head scratching, wondering, are they getting the benefit or not? Should they continue to spend at the current pace? That, to me, would be the biggest risk to the economy and markets if you really see companies spend less on AI and data centers going into next year. And that's the users, not the hyperscalers.
Mm-hmm. Peter, for as much as the U.S. stock market has done quite well this year, if you look over at Europe, Asia, emerging markets, they've actually outperformed us. Do you expect that to continue?
Yeah, I think there's a decent chance that continues. I think this kind of concept of production for security, it's going to resonate globally. And I think you're going to see more and more spending, more and more growth internally in some of those countries. I think there is still opportunity to, move forward. I really do think that this concept of production for security is slowly kind of replacing ESG as a main thesis for government policy and investment policy and ultimately corporate policy. So that's where I see the growth. And again, I think you mentioned earlier, one of your next guests is coming on about small caps. I think there's a big opportunity in the US here. So I like mid caps. I like global slightly better than big tech US right now.
In the bond market, Peter, 2025 was a very good year for the bond market, kind of high single digit total returns. You got rewarded for taking risk if you're in the high yield or the leverage loan business. Is 26 going to be a year where maybe we just clip coupons, which is not a bad thing given where rates are?
Yeah, I think we can maybe do slightly better than clipping coupons. I think you might see a little bit of spread appreciation as we kind of come through, year end. I think on yields, we might get a little bit lower, sub 4% on 10s, but it's going to be a clipping coupon. So again, I'd probably be under allocated bonds a little bit just because I think we've seen a lot of the decent price action. And again, I think some of those sectors that we talked about earlier can really outperform next year as these government programs gain, momentum.
How much is the Fed, we're going to have a new Fed chief as well, factoring into your overall outlook? Because this market seems to be banking on 2 interest rate cuts next year. If we don't get it, I'm not talking about hiking, because I think that's an outlier sort of scenario. But if we don't get the 2 rate cuts, what's that going to mean for the market?
You know, I've been thinking about that a lot. First, I actually think we're going to get 3 rate cuts. So I'm a little bit ahead of the market in that. And I do think this administration is going to do a much better job than the market thinks on keeping yield curves flat. I think people are really underestimating the willingness of Treasury and the Fed to work together next year to keep yield curves flatter rather than steeper. So I'm slightly bullish on that. Yesterday was an interesting day, right? We actually had this, really strong GDP. Bonds sold off, stocks initially sold off, and then they kind of bounced back. So maybe we are starting to move towards this good news can be good again. So long as yields remain stable, and there's no way this Fed's hiking. So I think we can actually get there with the Fed cutting even only once or nothing if growth continues decent.
Hey, Peter, I know at Academy Securities, your heritage is geopolitics in large part. You guys really focus on geopolitics across the globe and how it may impact investment markets here. What's your view towards some of these, big areas of interest like Ukraine here and the Mideast? And maybe what are you telling your clients these days?
Yeah, so I work with 30 retired generals, admirals, a couple CIA people who really do kind of form our geopolitical thing. One, we have to take the national security strategy report seriously. There is going to be a focus on North and South America in terms of where our policy. Just look what we're trying to do with Venezuela. I think we will spend a lot of time on Mexico next year once Venezuela kind of gets sorted. So I think from an investment philosophy, if you like EM, I think you do want to be concentrated in South America because I think that's going to get a boost from what the U.S. is doing. I think Russia and Ukraine, I really do think Europe had the chance to kind of seize Russia's frozen dollars or frozen reserves, use that. They didn't. I think we probably get pushed towards a peace deal, and it's going to be favorable to Putin. And weirdly, I think it's going to be very favorable to the U.S. I know this administration wants to lock in rights for U.S. companies in both Russia and Ukraine at the back of any peace. Trump is very angry that after the Iraq war, U.S. companies didn't get a good deal and have a long lead time in Iraq. He wants that for Russia and Ukraine. So I think that could be really interesting. So 2 other countries I'm looking at, Poland, I think benefits very well. And more of our geopolitical intelligence group is seeing Romania as being an interesting place. And then away from that, it's still all about this kind of friction between us and China. I think it's a race for us to develop rare earths and critical minerals, not the extraction, but the processing and refining. While we have to still make sure where China stands on data centers and AI, they are catching up and they do have an advantage in electricity. So that to me is the big friction area. I don't have a great call on that. I think we're leading. I think we're taking a lot of right steps. But I think we also might be a little bit complacent that China could have some more surprises for us that hurt some of our data center and AI companies.
And, when I hear us talking about international and geopolitical, of course, I think the dollar, the U.S. dollar has had a challenging year, Peter. I think it's down about 10% year to date against major currencies. Do you see that changing in 2026?
Not really. I think it's going to maybe do a little bit better, but I think it's going to have some ongoing weakness. When I'm looking at the dollar, I think countries and companies across the globe are still very comfortable owning U.S. financial assets. So they will own U.S. treasuries, they'll own corporate debt. Really, if you want to have a diversified corporate debt portfolio, you need to own U.S. corporate credit. So that's going to be a stable part of people's portfolios. Equities, right? It's really kind of a misnomer to call a lot of our stocks U.S. stocks. They're very global in nature. Also, if you want exposure to tech, you have to be in U.S. stocks. So I think you will see some upward pressure still on the dollar where people are buying financial assets. I think there is still a real reluctance, though, to build property, plant, and equipment in the U.S. Despite all the hype about all the trade deals where that's going to come, I think there is a reluctance to have dollars invested on the ground from a lot of foreign countries right now until they see whether policy is going to remain stable or not. So I think that pressures the dollar because we don't get those capital flows.
Peter, thanks so much for joining us. We always appreciate getting a few minutes of your time and the unique perspective of Academy Securities. Again, kind of the heritage coming out of the military academies and the U.S. military across all services in terms of the ownership and management of Academy Securities gives them a unique perspective on global politics and the impact on financial markets. Peter Tchir, head of macro strategy at Academy Securities. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
The one constant we do have today is newspapers with Lisa Mateo. Lisa, what do you got?
Okay, this one was kind of stuck out to me. It's a study surrounding affordability, especially when it comes to home ownership and what it means to the economy. So it talks about the younger generation who don't think that they will ever own a home. So basically they stop trying and they focus on just here and now. And so they had some economists, doctoral candidates, Northwestern University, University of Chicago. They built this mathematical model of consumer behavior. So here's what they found out. They found out that when people accept they'll never be able to afford a home, they put less effort into their job. They tend to spend less on luxuries. They do less long-term saving, and they're more likely to actually invest in riskier things like cryptocurrencies.
Oh, so it starts to snowball.
Yeah, it does. And it shows that's how it's kind of affecting the economy. And they're showing that, the U.S. government should consider grants for those people who are kind of giving up, I guess is the way they put it, giving up. But it's a good kind of insight into the struggles and just them just kind of throwing up their hands and saying, you know what, it's never going to happen. So
that's the first time I think I've not heard that before this generation or the last 10, 15 years. I know. And you feel like it's just, you could argue a house or a home, an abode is a commodity. Build more of them.
Right.
Bring down the cost, improve the affordability, but that's not happening, I guess. And I don't know why.
I guess it's more complicated than that.
Yes.
I mean, I don't know. It seems like no matter what they do, mortgage rates, even if they come down, that's only part of the large problem, which is inventory, which is prices.
Yep. Drew Redding. I'll tell you what I did. I was forced, and I was an investment banker, a young investment banker out of business school. I had to leave the metro area to go relocate to Richmond, Virginia, solely for housing.
Whoa.
And I was able to get a job there, and I made some more money, then was able to afford to come back up. But I had to leave the region.
You did it. Yeah, you had to leave the area.
This was in the 90s.
I had to live with mom and dad for a year.
There's nothing wrong with that. And more young folks are graduating and moving back.
But you're right. A lot of young folks, I think they're preparing themselves to be long-term, if not permanent renters.
And they see that's the only
put
option.
your money, put that down payment in the stock market, put that down payment somewhere else. I don't know. So it's different. It's a different way of life.
It definitely is. Okay, this one is kind of a different way of life, too, because you hear so much about the VIP lounges right in the airports and people flocking to them. Well, now they're saying that more travelers are enjoying the smaller airports, like the perks of the smaller airports. This was in the Journal. They spoke to travelers who said they like the cheap parking, they like the minimal TSA waits, and they like the friendly employees. So they say they like the atmosphere of it. They're willing to drive further if they have to, or some live close, so they like traveling closer. And they even don't mind the connecting flights, because usually at a smaller airport, you need the connecting flight.
In my professional career, I've lived in 2 small markets, and all that is true. You can pull right up, walk right in, you're on your plane, but you have to connect. And the worst thing is, having to connect coming home. And you're always going to miss your connection, this or that. Or, the stress associated with the connections, I found. Like, one of the things I love about living in Metro New York area, I don't connect for anywhere in the world. I don't connect for anywhere.
If I don't have to connect, I won't, because I've been down that road where you're on the plane and you're going, I'm going to miss this connecting flight, and I did miss that. And I ran through the airport, like with the commercials, and you're just running, and it was not a good story. But you do get the cheaper airfares generally at those smaller airports.
And now more airlines like Allegiant, Breeze, like all those airlines are coming more to the smaller airports, so it makes it a little bit more affordable.
In the last 24 hours, my knowledge of Coquito has quadrupled.
We talked about it yesterday, right? Yeah.
Now it's all over me. Like all throughout the day, I was getting Coquito from all different parts of media.
It is. You got to go to the New York Times. They have it how it's going kind of like mainstream. Even, listen to this, Jimmy Fallon made a song about it too. Take a listen.
That's the sound of the little coconut. That's Coquito. I put it in a cup.
Yeah, I love it. It's always been like this family thing, but the secret, right? Like everybody would hide their secrets in the family. But it's out there. It's on social media. There's different flavors. You have coffee shops in New York City having Coquito lattes.
This is the Puerto Rican drink, right?
It's
the Puerto Rican holiday drink. Okay.
Yes. It's condensed milk, evaporated milk, cream of coconut, rum, cinnamon. It's delish.
Next time bring them for all of us.
Well, I do have one in my desk, thanks again.
I see it.
I'm waiting until what time?
Lisa Mateo with the newspapers, Coquito.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.